Welcome to the channel. Today we're tackling a question that plagues many financially conscious individuals. Should you pay off your mortgage early or invest the surplus funds? Being in this situation is an achievement in itself, as you're already doing better than the 64% of Americans living paycheck to paycheck. This decision isn't just about numbers. It's about being a responsible financial adult and choosing the path that aligns with your goals and understanding. Let's cut to the chase. If you're not an experienced investor or don't aspire to be one, it's wise not to gamble with your hard-earned money. In such cases, directing your extra funds towards paying off your mortgage early can be a safe and sure victory. It's a foolproof win that no one can mess up, providing you with peace of mind and financial security. However, if your goal is to optimize your financial strategy and you're comfortable with some level of risk, then investing might be the more technically sound choice. But beware, this path requires a solid understanding of investments and a tolerance for potential fluctuations. For those who are curious about what is technically the most financially optimal route, stay tuned as we delve deeper into this topic. Remember, the right choice for you depends on your personal financial situation, your comfort with risk, and your long-term goals. Before we dive into this topic, don't forget to like, subscribe, and hit the notification bell for more insightful financial content. Let's explore the intricacies of paying off mortgages versus investing and find out which option reigns supreme for your financial future. Welcome back to our financial journey. In this segment, we're diving deep into the crux of the mortgage versus investment decision, your mortgage interest rate. This factor is pivotal in guiding your choice. Consider this scenario. If your mortgage interest rate is 3%, any extra payment you make is essentially earning you a return of 3%. For example, say you have an extra $100. If you apply it towards your mortgage, you're saving $3 in interest. In the financial world, a dollar saved is indeed a dollar earned. Now, the twist comes when considering investment as an alternative. To justify investing that $100 instead of paying down your mortgage, your investment must yield more than a 3% return. This is your benchmark. It's a simple yet powerful formula. If your investment return is greater than your mortgage interest rate, you're on a potentially more lucrative path. Let's add some complexity. If your mortgage rate is high, say 6%, then any extra payment you make towards your mortgage is like earning a 6% return, a challenging rate to beat in many investment scenarios. After taxes, the hurdle becomes even higher. Conversely, with lower mortgage rates like 2.7%, the scale tips more favorably towards investing. Now let's stir the pot with 3 curveballs that can complicate, but clarify, your decision-making. Stay tuned as we unravel these additional factors and provide a more nuanced understanding of whether to pay off your mortgage early or invest your surplus funds. Remember, the right financial path is not always a straight line. Like, subscribe and hit the notification bell for more insights into navigating these financial crossroads. Let's continue to unravel the layers of this critical financial decision. Let's add another layer to our financial analysis. For those leaning towards investment, it's crucial to recognize the availability of tax-free investment strategies. Instruments like Roth IRAs, Roth 401, KAs, HSA plans, and 529 plans offer lucrative avenues to grow your money without the tax burden. This can significantly enhance the appeal of choosing to invest over accelerating mortgage payments. Another key factor to consider is the potential for interest rate fluctuations. If you're currently dealing with a high-interest mortgage, the future might offer opportunities to refinance at a lower rate. This future possibility means you should stay alert to the ever-changing financial landscape and be ready to pivot your strategy as new, more favorable conditions emerge. Lastly, let's not overlook the tax implications on your personal income tax return. If you're itemizing deductions, the mortgage interest deduction can offer a tangible tax benefit. This effectively reduces the cost of your mortgage interest, tilting the scales slightly towards paying off your mortgage, especially if you're in a higher tax bracket. Here's a quick recap before I offer some final advice. Opt for investment if you have a low mortgage interest rate, possess savvy investment skills, and have a higher risk appetite. On the flip side, consider using extra funds to pay down your mortgage if you face a high interest rate, lack confidence in investing, or prefer a lower risk profile. Remember, the right choice varies from person to person. It's all about balancing risk, reward, and peace of mind. For those inclined to pay off their mortgage early, here are some essential strategies to consider. Tip 1. Prioritize high-interest debts. If you're juggling multiple loans, focus first on the ones with higher interest rates. For example, a credit card debt accruing 20% interest should take precedence over your mortgage. By targeting the most expensive debts first, you can significantly reduce the overall interest you pay, leading to more efficient debt management. Tip 2. Balancing extra cash and emergency funds. While it's tempting to use all your extra cash to chip away at your mortgage, don't overlook the importance of an emergency fund. Inflation may erode idle cash, but having a safety net is crucial. Resist the urge to rely solely on liquidating investments during emergencies, as this often leads to selling at inopportune times and potentially realizing losses. Aim for a balanced approach. Maintain a reasonable emergency fund while steadily reducing your mortgage. Tip 3. Opt for bi-weekly payments. Consider switching from monthly to bi-weekly mortgage payments. This simple adjustment can accelerate your mortgage payoff by up to 8 years, saving you a substantial amount in interest. Bi-weekly payments effectively add one extra month of payment annually, making a significant impact over time. Remember, the journey to mortgage freedom requires careful planning and a strategic approach. In this final section, let's explore the optimal approach between investing surplus funds or accelerating mortgage payments. For those leaning towards investing, I strongly recommend utilizing tax-free options like Roth IRAs, Roth 401, KS, HSAs, and 529 plans. These instruments offer significant advantages, particularly in long-term tax-free compounding effects. While having a regular brokerage account is fine, the benefits of these tax-efficient vehicles are too substantial to ignore. They can truly be game changers in building your wealth over the years. The ultimate decision between paying off your mortgage early or investing is not clear-cut. It hinges on your unique financial situation and goals. For instance, even with a low mortgage interest rate such as 2.7%, investing in the stock market through index or mutual funds could potentially yield higher returns over time. However, if being debt-free and the peace of mind it brings is more important to you, prioritizing mortgage payoff is entirely valid. Some individuals may need guidance on leveraging good debt, while others are fully aware but prioritize mental ease over financial leverage. Both choices, paying down debt or investing, are commendable and can lead to financial betterment. Ultimately, whether you choose to invest, pay off your mortgage early, or blend both strategies, you're already ahead of many Americans. My goal is to provide you with the knowledge to make informed decisions tailored to your unique financial landscape. Remember, there's no universally right answer, but armed with the right information, you can confidently chart a course toward financial freedom. Thank you for joining me in this exploration. If you found these insights valuable, please consider subscribing for more financial wisdom. Your support is greatly appreciated. Stay focused on your financial journey and take care.